Okay. So welcome to the University of Rochester for a virtual panel on trade and politics in a post-COVID world. This is part of our inaugural Ron Jones seminar in international macro and trade. We're sort of meeting at a time that is, where trade is kind of in the crosshairs, or has been in the crosshairs for the last few years. I think part of that is we don't have a good sense of the evidence that trade is this great benefit for the world. And I think every time we go through an election, we kind of revisit those. And we saw that the trajectory for trade integration changed quite a bit in the last election in the US. Also, anytime we have a downturn in the world, it often changes the way that we think about the benefits of integration. So we're very delighted. We have three excellent speakers, all with a very close Rochester connection to share their views. They are, just excellent leaders in doing fantastic research on the interconnection between countries. The first speaker will be Beata Javorcik, who is an undergrad from the University of Rochester and has been a professor at Oxford University and is currently there as well, but she is also the chief economist of the European Bank for Reconstruction and Development. We'll then move on to Rick Bond, who is a professor at Vanderbilt University and is a Rochester graduate from our PhD program. And then we'll shift to Mara Crucini, who is another one of our PhD alums and has done some really interesting work on trade policy in the Great Depression, which might give us some lessons for the outlook in the future. So without further ado, we're going to start with Beata. Each panelist will talk for a bit, and then we'll try to have a stimulating discussion. I'm sure it'll be great. So take it away, Beata.
Thank you very much, George. It's a great pleasure to be part of this conversation. I left the U of R more than a quarter of a century ago, so it's a pleasure to be back, even though it's only virtually. And I'm particularly happy to be participating in this event bearing the name of Ron Jones. So let me share with you a few observations and perhaps a few speculations about what changes in international trade and investment we may see after the pandemic. So let me start with global values. I think we are going to see some reshaping of the GVCs. COVID has certainly drawn attention to dependence on China. China as a supplier of personal protective equipment, China as supplier of antibiotics, blood thinners, other medication, but also China as a supplier of high-tech input. And there is recognition that diversification is something we may need to think about, not only because we are likely to see continued shocks to trade policy, but also because as the climate change progresses, we are likely to see more extreme weather events. So the longer the supply chain, the greater the exposure to such rare events. And, one thing that COVID did is has drawn attention to those low probability events. And suddenly we have become much more aware of them. On top of that recognition that perhaps there's a need to move from just in time to just in case, we have political pressure. Many political leaders are talking about reshoring, are talking about tying support to firms, to commitments to be made by firms to bring some high value added production back. Of course, this reshoring, this reshaping and diversification will not happen tomorrow because cost implications are a powerful counterforce. Nevertheless, I would expect that as automation progresses and as firms are undertaking new investments, they will be keeping resilience in mind. And that means that some countries that may not have been preferred investment locations can actually see bigger flows of FDI and can get a bigger chunk of the global export market. And here you see a chart we've done at the EBRD where we look at products in which Germany imports a lot of from China, so a large share of German imports at the product level comes from China. And these are the products where countries where the EBRD operates, so countries in a very broadly defined European neighborhood have revealed comparative advantage. And you can see that because many of them produce similar products as China, there is potential for reshoring there. So these countries may potentially benefit. The second thing I want to focus on is the role of trade finance. So we have all seen that in the initial stages of the pandemic, there was a big drop in trade. If you look at France, it was on the order of 40% relative to historical average, and a similar number in Turkey. But perhaps others may want to mute as I hear some noises. But that's not the interesting part. The interesting part was that not all trade flows have done equally badly during the pandemic. So one thing that happens is pandemic created a lot of uncertainty. And in times of uncertainty, exporters are very worried about whether they will get paid for the goods they're shipped. Importers are worried that if they prepay for the shipment, will they ever see the goods arriving? So during the pandemic, ability to ensure trade flows using trade finance instruments such as letter of credit, which basically means that a bank is an intermediary between the exporter and importer and takes on itself the burden, the risk for a fee, the demand for trade finance goes up. And what you see is, if you look at detailed data on Turkish exports, you see that in March, exports on cash in advance terms, otherwise known as pay and pray, have dipped by about 40%. And the little black line, that's a confidence interval. Export flows on open account. These are export flows where the Turkish exporter ships the goods and gets paid only later, went down by almost 30%. But exports on letter of credit have not registered any decline. If anything, the share of exports using letters of credit, so insured through letters of credit, has gone up. And overall, you see a big increase in March. Again, you see here confidence intervals. When you zoom in on exports going to China, this increase in reliance on letters of credit was noticed somewhat earlier, which is intuitive as China was hit by the pandemic earlier. Now, it matters, right? Because if we go back to the global financial crisis, to the great trade collapse that we observed there, inability to ensure trade flows was responsible for about 1/10 of this great trade collapse. As exporters and importers were unable to push the risk associated with trade onto a bank, many export transactions have not happened. Now, but now the situation is actually more difficult when it comes to trade finance than it was a decade ago. And that's because many relationships, so-called corresponding banking relationships between banks in advanced countries and banks in emerging markets have been cut. At the EBRD, we did a survey asking banks, why have you stopped your corresponding banking relationship with an institution in an emerging market? And banks in Western countries told us, well, it's because the cost of due diligence are too high to justify the business we get. And that answer was given by about 60% of respondents. And when we tried to dig deeper and ask exactly what cost they had in mind, half of the respondents pointed out to high due diligence costs associated with anti-money laundering legislation and with legislation aiming to prevent financing of terrorism. So these rules, these so-called know your customer rules, are very onerous, and if you don't have a lot of business with those emerging market banks, you just don't want to take on the risk. But that's a problem, because uncertainty may continue or is likely to continue as the second wave emerges, perhaps the third wave. So the lack of supply of trade finance is going to hurt trade from emerging markets. Now, another thing it may do is it may give advantage to multinational firms over smaller national players. And that's because multinational firms do a lot of trade intra-firm. They trade between headquarters and subsidiaries, or just between subsidiaries, and there is no risk. There is no need to ensure those trade flows. And indeed, you see that during the global financial crisis, intra-firm trade was more resilient than arm's length trade. Now, moving on, let me switch gears and talk a bit about remote work. We've been thrown into this remote work arrangement from one day to another. And yes, it has been happening before, but before there was a lot of hesitation. Bosses were worried about workers not working very diligently. Workers were worried about being passed over for promotions. But now we've all started this giant experiment. And it seems that many firms will continue with some sort of hybrid arrangements where many days will be spent working remotely and only a few days will be spent in the office. So if remote work is here to stay and you are a firm in London, why do you need to limit yourself to workers located in London or even in the UK? Why not hire somebody from Poland or Romania? Of course, there are some limitations. They are related to time zones. They are related to data protection regimes. In some cases, for instance, in financial services, some countries impose restrictions on data leaving their national borders. And of course, travel restrictions matter as well, because you still presumably have to visit the headquarters of the company. Nevertheless, I would expect that countries with inexpensive skilled labor stand to gain from this increased prevalence of remote work, because they will be able to export services. After all, we have all reaped the low-hanging fruit by relocating production of goods to low-wage countries. Services are the next frontier, and exploiting differences in wages of skilled workers, this is what may be enabled through this remote work arrangement. So again, this is an opportunity for countries like those EBRD works in. Now let me move on to the FDI. The latest World Investment Report put out by UNCTAD talks about pandemic limiting FDI flows very much. And that's because many new projects were stuck during lockdowns. That's because firms were making less money and therefore reinvesting less. Globally, reinvested earnings account for about 50% of FDI flows. And of course, a recession decreases appetite for new investment. And on top of that, pressure to reshore, pressure to rethink global value chains means that we may be seeing some divestment. So UNCTAD estimates show that this year, global FDI flows will be 40% below last year's level. And UNCTAD expects them to stay so low for 2 more years to come. So that means that global FDI flows will be below the level we saw after the financial crisis. So much less FDI available globally, greater competition on part of countries for FDI inflows. Does it matter? Yes, it matters, because FDI, it's not just about investment, it's not about jobs, it's primarily about knowledge. And we know that foreign acquisitions lead to improved productivity. We know that FDI brings spillovers. So the question is, what is the implication of those divestments that UNCTAD is predicting? Is it that those good FDI projects that brought knowledge, that this knowledge will remain in those former foreign affiliates, or will they decline as the source of knowledge flows from headquarters is cut off? And here, the news is not very good. In this particular graph, you can look at foreign affiliates. These are foreign affiliates in Indonesia, which stayed in foreign hands, and that's the dashed line, and you can compare them to foreign affiliates that were divested. This is the solid line, and the vertical line shows the time of divestment. And you can see that these two groups, they are matched, right, through propensity score matching. So they are very similar in terms of a host of observable characteristics. They operate in the same industry, observed in the same year. These two lines move in sync prior to divestment. But after divestment happens, those foreign affiliates that are ditched by their foreign parents suddenly exhibit a drop in productivity. And this is a permanent drop which continues. And it is to a large extent associated with loss of access to export markets. But that's not the only channel. You also see that even those affiliates that were not exporting registered this drop. So this is most likely due to no more headquarters services being sent to foreign affiliates, to some foreign managers leaving and no longer working for those projects. Another implication of FDI retrenchment is on the climate front. We know that foreign affiliates are more energy efficient, so they help countries in transition to low carbon reality. And here you see what happens after foreign acquisitions. It's also in Indonesia. You see that acquired firms improve their energy efficiency, and this manifests itself in lower CO2 emission intensity. So to close, I think we are going to see some reshaping of globalization. Perhaps fewer goods will be traded, but new types of services may be traded associated with the remote work arrangement. I think that lower supply of trade finance that we see now may result in less resilience of exports from emerging markets and growing advantage of multinationals over local firms. And finally, lower supply of FDI flows may translate into slower growth and slower green transition in emerging markets. Thank you. Over to you, George.
Thank you, Beata. What a thought-provoking presentation. It's really interesting how things may change and how different this may be after compared to the previous recession we went through. So let's shift off to Eric Bond, who's going to give us a little bit of insight into how trade policy is being conducted and at the WTO and beyond. So thank you, Rick.
Thank you very much, George, and thank you for inviting me to participate in this. I really appreciate it. Ron has had a huge impact on my career, and it's an honor to be able to participate in this conference. So my topic today is going to be our pandemic and politics killing multilateralism. And I'm going to focus on the effect of the coronavirus and the breakdown of dispute settlement and sort of what we can expect going forward. So with the pandemic, what's happened is that countries have responded with their trade policy by taking trade actions to try and lower the domestic price of pandemic-related goods, medical goods, face masks, personal protective equipment, et cetera. Importing countries are cutting tariffs, reducing VAT adjustments at the border, and exporting countries are imposing export bans. And as this started to happen, the WTO and the IMF issued statements encouraging countries not to impose export bans because of the spillovers effects, the fact that these are going to damage supply chains and et cetera. And interestingly, in contrast to the financial crisis, where a call like this led to statements by countries that they were not going to increase tariffs, there seemed to be much less effect in the case of the medical goods. And so there are 59 countries reported to the WTO to have some form of export restriction on medical related goods. And that's probably an undercount because not everybody has reported. And so one question is sort of why is this, I mean, the good news is this hasn't expanded, maybe with the exception of food export restrictions. It hasn't expanded broadly to a trade war, but it has still disrupted supply chains and disrupted supplies of medical related goods. And so one reason I think is that these bans are actually legal under Article 11 of the GATT agreement, which says that that quantitative restrictions, one of the exceptions is for essential products. And so a country could argue that what they're doing here is not necessarily in violation of the GATT agreement, the WTO. Now, one of the things you could do is you could make these illegal, but given the rate at which the dispute settlement process works, if there is one in place, that's probably an ineffective way of trying to deal with this. And so, I guess the question would be, is there something that can be done to facilitate cooperation among countries to get to a more cooperative outcome? Is there some way that the WTO could do that? Absent that, it seems like that countries should be thinking maybe about anticipating export bans in the future in case of a pandemic like this, and maybe that they should be pursuing domestic policies to try and ensure local supplies in the event of a future crisis, if you can sort of identify critical goods. The other thing that is of concern, certainly from multilateralism, has been the breakdown of the dispute settlement mechanism. Currently, it's inoperative because of a lack of appellate judges. The US has vetoed the appointment of appellate judges, so you need 3 and there's now only 1, so the system is basically broken. And so if there's a panel ruling that you want to appeal, there's nobody to appeal to. And the question is sort of what's going to happen in the future, and is the dispute settlement process sustainable? You draw a comparison between the GATT system, where any country could block a panel report, so including the country that the ruling was against. And so there were cases where there were findings against countries, and the country that was found to have violated the agreement simply blocked the report. And so the idea behind the WTO system was that we're going to come up with, make the decisions binding on the participants so that we have a much more effective means of enforcing rulings. And the problem is that it's not clear that even if we had a change in administrations, that the US would want to restore the system. Because in fact, the vetoing of judges took place in the Obama administration as well. And I think there's a question here of whether a strict system like this is really sustainable, because requirement, in a trade agreement, you require that the agreement be self-enforcing. And so it's not clear that with a major player could choose to walk away at some point, that you can sustain this. And so in fact, the best that one may be able to do is something like the old GATT system, where you can walk away from that. And a lot of the disagreement over the panel outcomes involves trade remedies. anti-dumping, safeguards, countervailing duties that provide sort of temporary protection to sectors. And one of the ideas that sort of I've been pushing in some work with Mustafa Beshkar is this idea that in designing trade agreements, there's a flexibility commitment trade-off. That rigid tariffs have the benefit of eliminating trade policy uncertainty. But on the other hand, it takes away the ability of politicians to respond to political pressure. So politicians like to have what in the political science literature is referred to as policy space. And a very strict system will take that away. And in the work with Beshkar, what we've shown is that if you look at a situation where countries have some private information about the degree of political pressure, so the rest of the world doesn't know the full extent to which the president values protection of a particular industry, say, and there is some costly state verification. So it is possible to find out information which would nail down sort of the extent of losses and so on. That optimal contracts would look like, have something like an escape clause in them. And the idea being that, you know, if things get bad enough and it will be in your interest to report that, you know, and then there will be an investigation and that will lead in what would be then a more efficient tariff. So, and one of the negative things that's happened in the dispute process is that the appellate body has basically made it impossible for advanced countries to use safeguards because they've ruled against, I think, all of the safeguards from advanced countries. So just, you know, to sort of summarize this, I think in terms of multilateralism, you know, to proceed, there's got to be some more flexibility, that there has to be mechanisms which allow response to political pressure, so that we were maybe too optimistic about how much rigidity and trade liberalization we could have, because as we've seen, players can choose to opt out of these agreements if they don't see sufficient future benefits from them. So
Thanks, Rick.
Stop there.
No, that's great. I mean, I guess one question I would ask, just to not to get into the discussion too much, but is, does the political pressure rise in downturns? I mean, we saw that after the Great Recession that a lot of attempts at multilateralism were put forward, but just didn't go anywhere. And so do we face like an even more daunting challenge as we come out of COVID?
Yes, I mean, I think, you know, it tends to be, I think, associated with losses and downturns in particular sectors, and that's likely to be a broader based effect, yes.
Great. Well, thanks, Rick. And I think we'll turn next to Mario, who's going to talk a little bit about periods where the world was not so positive on trade. So we've got Mario Crucini, who is professor of economics at University of Vanderbilt. So,
thank you, George. Thanks very much for the invitation. It's always fantastic to get back to Rochester, whether it's virtual or in person. I was back for the Carnegie Rochester, where Plosser's 60th birthday was celebrated. We had the 25th anniversary of the Midwest Macro meetings in 2015. It's always a second home intellectually. Thanks very much. I just wanted to mention, excuse me, a word. People sometimes ask me who I was a student of in case they forgot. I was not an advisee of Ron Jones, but I took his micro theory sequence when he offered it. And my response now to that question will be, if someone asked me if I was a student of Ron Jones, I'm just going to simply reply, of course, aren't you? I think we're all students of Ron Jones. So wonderful, wonderful man, great intellect. So, and none of what I'm going to talk about is Ron's responsibility or blame either. So I'm going to take a bit of a historical walk through US tariff history, make some remarks in terms of the international counterparts. Part of this is just to put in perspective where we are now relative to where tariffs were in a period that people make statements about, but maybe haven't quite studied really carefully. And that's the Great Depression, the interwar period. So I'm going to zoom in. This is a Vox article, and I didn't prepare slides, but I think this picture is going to guide a lot of my discussion. And I'm going to zoom in on two parts. I'm going to start on the part that's a bit more familiar, perhaps, to people in the room. And that's kind of the, what I would call the contemporary era, if you're thinking about history. And obviously it doesn't include the Trump tariffs towards the right-hand end. So this is basically the index of dutiable imports, the ad valorem equivalent rate. And what I've marked off here on the with the dashed lines are the GATT rounds of tariff negotiations, and many of those were phased in. GATT rounds after World War II, we see some sort of gradual but not dramatic declines up until the Kennedy round, plummeting from about 10 to 5% in after the Kennedy round, and then they're kind of pretty stable from 1980 through 2000, and stable at a very low average level. Now I'm going to speak in a moment about the average is sort of deceptive, particularly historically, because of course there's a second moment to the tariff distribution. And that's really important to think about. What items are being hit with tariffs, what items are not being hit with tariffs, and also what sectors, obviously. So we've seen increases now that put the tariff rates up. They've been a bit more targeted than historically, but they're obviously something to be concerned about. If we go back to the earlier period of history, it's going to look very different in a number of ways. So this is a similar index for the US, customs revenue over dutiable imports. You notice the first obvious thing is the average is about 35% from 1896 to 1950. So there's a substantively higher average tariff rate over this period of history. I've also marked off legislative dates here, and those probably aren't very familiar to people, except possibly for Smoot-Hawley, which is this one right here. So the Smoot-Hawley Tariff Act went into effect in the middle of 1930 in June. There's a lot of discussion in the historical literature of whether the Smoot-Hawley tariff was a response to economic activity or contributed to it. The United States was not on the verge of a downturn when the discussion began. So the history of Smoot-Hawley predates the Great Recession in terms of the US narrative. What's more often discussed is World War I increased agricultural prices dramatically. Farmers did very well during that period, and some of them leveraged and purchased more acreage. And the early 20s was a collapse in agricultural prices, and there was push. And that then propagated a bit more broadly thereafter. You'll notice, it might be a little hard to visualize this, but if you take these dashed lines of legislative changes and you join them, and kind of one of my small contributions to tariff history in my dissertation was to ask how much of the change in the tariff is due to legislation versus other stuff. And what is other stuff? Other stuff can be two things. One can be the change in the composition of trade that has nothing to do with the legislative schedule, which is a concern when tariffs differ across sectors. That's one. So this can move around even if the rates are not changing product by product. But in this period of history, there's something that's even more important, and that is there was a prevalence of the use of what are called specific duties. So specific duties basically call for tariffs at 10 cents a pound, 5 cents a bushel and so forth. So if you decompose the tariff history into price effects and legislative, turns out that this big liberalization here in the early teens is in fact World War I inflation principally, driving down ad valorem equivalent rates and specific duties. And the deflation of the 30s added substantially to ad valorem equivalent rates in that period. So what's going on here? And I think this is interesting, not just for a historical tariff perspective, but in terms of macro dynamics, because we think about anticipation of tariff changes and variation of tariff changes. It turns out the interwar period is rife with this, but a big part of it is not the legislative changes. Legislative changes are sort of mean reverting the average tariff rate. They're moving it back towards the long run mean. The variation is really like a monetary propagation mechanism. And, Alan Meltzer talked about this, Milton Friedman talked about this, that tariffs were rising due to the deflation, and that was kind of interfering with the price specie flow mechanism, or put differently, just relative price adjustment. Maybe not even too abstractly, if tariffs are moving in the opposite direction of relative prices, you would generally expect an exacerbation of the business cycle dynamics. And, Jim and I followed up on that in a paper in the JME, and we sort of claim that about 1 to 1.5% of the cyclical decline in the U.S. was due to the deflationary effects of that nominal rigidity. In fact, so this is kind of, I've gone through the history a little bit here, just to remind us that there were periods that were worse, obviously. So George alluded to, Great Depression. I'm not thinking we're heading for tariff levels that would rise to a Great Depression, or even to the level of a sizable recession. But we do need to keep in mind that the effects on tariffs of the U.S. were small for the United States, but they were devastating for many countries like Cuba, for example, that exported sugar and tobacco to the United States. Or Canada. So there were countries that were collateral damage to what would have been a small aggregate effect on the U.S., which is a large integrated economy, obviously. They were very consequential, and not that the Smoot-Hawley tariff was trivial for the United States either. Now, behind this picture, there are other pictures in this Vox article about the variance of tariffs in the cross section and their sectoral impacts. And I just want to amplify that as a number of the presenters during this conference have quite carefully emphasized, material inputs, there are distortions to downstream production and final goods. Those are very important dimensions to think about in commercial policy. And we looked at them as well, and others have in this context. And also, retaliation, obviously, the general equilibrium effect. This was a period where there was significant retaliation in the 30s, but some of it was also this deflation-induced retaliation. All countries deflated, more protection. So I think, I don't know, it may have gone over there, I'm not sure. I apologize, but I'm happy to listen and chat about these diverse set of topics that have been placed before you, but it's all very interesting stuff. Thank you.
And thank you, Mario. And we can stop sharing the screen. And great. So, wow, we covered a lot of ground there and a lot of interrelated themes. Why don't we just open it up to see, if anyone who's at the conference would like to make a comment or ask a question of our panelists. I think one question that I sort of was struck with was, I guess, with Beata's and also Rick, and maybe a little bit of Mario's discussion, which is, the world is somehow changing and firms are making decisions that are forward-looking decisions. And we're now kind of in the third or fourth shock of the last 10 years. And the trade-offs between reshoring and preparing for these types of events are coming into focus. Are people, do we have some sense that people are reevaluating the benefits to trade in a strong way following this last shock that would be kind of moving us more towards reshoring these days. Seems like reshoring is not the right answer to having mass production in every country, but I think that's something that people might be talking about. So I don't know. I'll throw that out there if anyone wants to offer an answer.
Okay, maybe I can just tackle one little piece of that. So I think a big part of this is not just the uncertainty of future tariffs, but how persistent they will be. So obviously, when we ran that business cycle model, the persistence of the tariffs, which was giving the large capital accumulation effects, if tariffs are going to switch on and off at high frequency, that changes the incentive to invest in certainly structural physical capital capacity, right? So I think that's a really important facet. How durable is any change in the tariff structure coming out of, say, a Brexit, COVID, or other changes we've seen, the Trump tariffs recently? That's a really important facet, I think.
If I may jump in, to what extent is WTO fit for purpose going forward, right? If we think about China joining the WTO almost 20 years ago, China joined on pretty tough terms. But one thing we didn't worry about was state subsidies, state aid that may be channeled through state-owned enterprises. And that was because, this was the end of history, communism was discredited, nobody expected that SOEs would persist in China. What's interesting now is if you look at public opinion, it has been steadily shifting towards support of state ownership and expansion of state role in industry. So in advanced countries, about a third of people favor expansion of the state in business. In countries, in emerging markets, in post-communist countries, it's 45% of people. And I suspect that COVID is increasing expectations we have vis-a-vis the state. It's increasing acceptance of the state role. On top of this, we have governments taking equity stakes in firms. What will it do to WTO rules on state aid? They will be completely unfit for purpose. And also, I worry about the fact that now that every government is helping firms, it will be incredibly easy to make an argument that imports are subsidized, and protectionist-minded governments will use that to introduce countervailing duties. So I don't think, to answer George's question, I don't think we have discredited reshoring, but now there's an opportunity for populist governments to convince the public that we need to build resilience, because people still remember the pictures of shipments of, PPE being stopped within European Union at the border.
So on the state-owned enterprise point, I'd also point out that that's one of the U.S. primary complaints against the appellate body, is the way in which subsidies to by state-owned enterprises or to state-owned enterprises are being dealt with by the appellate body. And that, I think that was part of the reason for not taking these cases to the WTO, but instead taking a sort of unilateral approach.
Thanks. We have a question from Lorenzo Caliendo.
Yes, I want to basically make a comment on Eric's discussion. That was very interesting. Actually, the three of you guys were amazing. True, in fact, I was calculating some numbers. If you look at the total, if you want, imports of goods in the world that have been affected, goods which are essential for COVID, that have been affected by any type of restrictions, export restriction, we're talking about 30% of the goods imported have been affected by somehow an export restriction. And this seems to be worrisome in the sense because many of these goods, in fact, to produce them, you need intermediate goods from countries which are in fact importing them. So this idea of that yes, I can basically restrict the exports of essential goods, but naive in the sense that part of the intermediate goods that I need to produce these goods are basically imported from the countries in which I'm importing some restrictions. So I wanna basically ask, I guess, Eric, or maybe the panel in general, going forward, and in particular about Article 11. Article 11 basically makes a case that yes, in principle, for essential need, a country can impose quantity restrictions. Will this be a reconsideration of these types of rules going forward? What do you think, Eric?
Well, so I'm not sure it's practical to do that, basically because anybody who violates that, how are you going to enforce it? I mean, there's a long lag in dispute settlement. Things aren't retroactive penalties. So, you know, absent some sort of better coordination mechanism, you know, if the WTO could somehow actively coordinate, you know, exchanges of market access, say. But, you know, we know those discussions take a long time too. So, you know, I think you sort of got to live with, this is one of those things that you're not going to be able to stop and, you know, adjust domestic policy appropriately. I mean, that's kind of my feeling about it.
If I may jump in on export restrictions, right? So we've heard export restrictions on food mentioned. That was to a large extent driven by weakening of emerging market currencies, where countries were worried about domestic food inflation. And that was, in many cases, what was driving these export restrictions. Luckily, many countries removed them. But you know, the damage may have been done, right? It was known that there wasn't a problem with food supply, so we didn't see huge spikes in food prices, but the damage has been done because now we have given populist reasons for why one may want to have protectionism, because they will peddle the self-sufficiency argument, and that's why these restrictions have been very harmful.
So on the food point, there have been several past episodes with world supply shocks of export taxes by food exporters. So I mean, the same sort of issue has arisen in those markets. Interestingly, in this case, it's export bans rather than export taxes, but you know, still driving up the world price.
Right. I mean, I think there's a great example of that in the United States in the 70s, where we put bans on, I think, soybeans, and it really stimulated a lot of soybean production in the rest of the world and permanently changed the pattern of trade. I
wasn't sure if we were just asking, you know, whether we should be puzzled by the fact that governments are trying to restrain export of things they think domestic citizens would want to have supplies of, or whether that's optimal in some coordinated equilibrium that might be an alternative. But, you know, so in some sense, it's not entirely surprising. It does have unintended consequences. But that kind of goes back a little bit, I think, to the endogenous tariff question, right? Why do we have tariffs? Why do they change? Well, you know, in this very critical COVID event, it is a kind of another type of experiment as to what do politicians respond to in the heat of the moment. And I think these things that are critically necessary that are in short supply is a very natural thing to be investigating, kind of at an academic level, just to understand that before thinking about what the alternative policy might be.
Okay. Do we have any more questions from the floor?
I have a question. Yes, I have a question for maybe for Bita. I think your talk is very interesting, and it's pointed out that this post-globalization might be very different from before. I think it's also very important for all the countries, but in particular, probably for emerging markets. I think it's always before, like we all I guess I wanted to ask is, what do you think is the role of international institutions like WTO, or World Bank or IMF, they have what policies they should do or how to help over emerging markets. And like for example, in the after financial crisis, we should they were telling countries you should open up, but then should be careful. You should adopt the macroprudential policies. Like for this time, what do you think should be what's the role of international institutions? Thanks.
So one difference between now and the previous crisis is that after the global financial crisis, G20 came out very early and said, right, we are committing to free trade. We haven't seen such a commitment this time. So this is going beyond IFIs, just more to sort of international cooperation. In terms of how multilateral development banks can help is, for instance, support trade finance instruments. At the EBRD, we are very active in this space. We've been even called Avengers of Trade. And we have seen big increases in demand for trade finance. Other area, sort of it's very obvious, is, broadband, help countries with broadband infrastructure. And, there are these things we keep on repeating ad nauseum, improved customs procedures. And it's, we keep on repeating these things, but this is really a big deal in many countries. So there are many things that can be done, right? And particularly if countries, if there will be reallocation of those global value chains, and if there are countries that want to capture a bigger share of the market. Having smoother customs will certainly help.
Great. Thanks, Jan, and thanks, Beata. Do we have any more questions from the floor? I saw that there was something in the chat, but
no, that was from me. This is Shamin.
Shamin.
Hi, everyone. Yeah, so I just wanted to, add to Beata's point on this one. But another, on the same lines, I have a question that I think Mario's presentation also focused on the tariff barriers and things like that. But the non-tariff barriers, and I think that was what Beata was talking about when she said that the subsidy that the state provides, let's say in kind to the state enterprises, and she also mentioned that in the emerging economies there are, support for big state enterprises. But sometimes there are also crony capitalism that can also develop, where you basically allow one conglomerate to become extremely big, and they start dominating not just the internal market. I don't know to what extent they can be successful in trying to dominate the rest of the world, but that can also happen. So are you also seeing a a trend towards, let's say, bigger concentration in industrial developments within countries, and how does that affect international trade more generally? It's just for out there for anybody to perhaps respond. I don't have anybody specifically in mind.
well, we've certainly seen a rise in concentration throughout the world, and that's I will refer to another Rochester event that's going to be happening in the fall. That's the topic of the Carnegie Rochester NYU workshop in November. So I wish I had a good answer for why concentration is rising, but that conference is entirely on that subject. And some papers will be dealing with the globalization and the policy side of it. Stay tuned.
I guess technology to a certain extent is a pretty clear answer. I mean, these days, the big companies are, let's say, like the Amazons, the Facebooks, and those companies of the world. And obviously, sure, it doesn't appear that their scale economies has been fully, realized, even at this time. And, obviously, they are extending this hegemony, not just in one particular sector, but, across sectors. Mm-hmm. And obviously in emerging markets, you have business group type situations where, one company tries to spread out into many different types. They're often helped by government regulations explicitly. And that's the sense in which I brought up the crony capitalism kind of thing, to basically, grow bigger and bigger. So that's what I just wanted to Thanks for actually getting me.
Thank you. I guess, an important thing in trade policy has been to convert non-tariff barriers into more quantifiable direct tariff barriers for this very reason. So
I was just going to add, that, capital is the most mobile factor and multinationals embody it. So presumably some regulatory arbitrage and border arbitrage explains some of the concentration toward multinationals, right? This is true for labor unions back in the day, and it's probably true for environmental regulation today.
Two sort of related comments. I think as we go forward and as countries emerge more indebted, they will be desperately looking for new sources of tax revenue. So I think the issue of taxing tech giants and closing loopholes when it comes to transfer pricing, tax management, I think that will become much more salient. And there was already at the end of last year OECD proposal on international taxation. Perhaps as countries become more desperate to find revenue, we will make some progress on that side. The other thing that we haven't mentioned is carbon adjustment tax collected at the border. That's another space I think we should be watching. The EU is running consultations about it. Potentially it could be compatible with the WTO rules, as it wouldn't discriminate against foreign and domestic entities in a way that VAT doesn't. But the big question is, would there be retaliation should the EU impose such a tax? And I guess to a large extent, it depends on the outcome of the US elections.
great. Does anyone else have anything to add? Any more questions from the audience? Okay, so this has been a really interesting panel discussion, and we'll see. I guess time will tell where we head. I think there's a lot of uncertainty going forwards, and we can hope for the best. But it's good that we have such bright minds working on these issues these days. So let me thank all the panelists and thank all the presenters today for the conference. We will kind of call it a wrap here for our broadcast.